So companies that are traditionally, let's say, are in the S&P that are not moving forward, they are not going to be in these new democratized portfolios. They're not going to be in these new sustainable strategy portfolios. And that's what the tectonic shift we're seeing. We're seeing companies that are moving forward faster, they're included, so they have more capital running into their equities. Companies that are in the same industry that are not moving as fast, they're seeing, outflows in their equities, and you're going to see a reassessment in the PE ratios in industries of different companies. And so we are beginning to see this whole change in terms of how we could democratize sustainable strategies. And I believe we're at the beginning of this. I wrote in my 2021 letter that I've been in finance now 40 odd years, and I was at the beginning of the mortgage-backed securities market. I believe we're at the beginnings of finance now adapting completely. Sustainability is a major risk factor in how we invest. And I believe that will be shaping capitalism. And I believe it's going to be shaping more winners and more losers as more and more capital is moving into sustainable strategies. I would say COVID and the existential risk of health has actually fortified people's view of climate risk and how climate risk is an existential risk of the health of the earth. And so if anything, during this pandemic, we're seeing an acceleration of capital moving more towards sustainable strategies. We are hearing from more and more clients who are saying, how can we invest in new technologies to bring down the green premium?
Before we close here, can you please share your views on the markets? I mean, we talked a lot about long term and how we invest with a 20, 30-year time horizon. Mm-hmm. But we saw a massive improvement in the markets overall in the last semesters. I mean, do you think everything is priced in? Do you expect the market to continue to perform well overall? And we saw something very interesting as well in the U.S. Treasuries yield curve, where inflation is becoming more and more fear factor, and the curve is flatter. I mean, how do you see these signals and the performance of the market in the short term, please?
Well, I do believe fiscal stimulus in the United States will continue to be very large. It appears that the infrastructure bill is going to be passed. The Democrats are talking about a big social program, which we'll see what happens there. But you still have a very accommodative central banks worldwide. And the pool of money that we are seeing is extraordinary. We're talking trillions of dollars of money that needs to be put to work. So I'm a believer that we still have a couple more years of equity market strength. If you look at earnings are validating valuations. Valuations are on the high side. So I don't want to suggest that valuations are cheap. And some valuations are crazy, so I don't need to go there too. But overall, the valuations are expensive, but not extreme. I would say though that earnings are validating those extreme valuations. And when you think about the alternatives of buying a 1%, 1.2% US 10-year, I'd much rather own equities. Now, you're right in suggesting that the US yield curve is flattened, and we're back down to very low 10-year rates. I'm a believer that we are going to witness more and more inflation, and it's not transitory. I believe inflation is, whether it's the movement towards onshoring of manufacturing, that's inflationary. Let's be clear. If we don't solve the green premium as we move towards a decarbonized world, that's very inflationary. If we just automatically say we're going to reduce hydrocarbon usage and we're going to go use green strategies tomorrow, that's very inflationary. And so over a long horizon, I don't see any real value owning a 1.2% US Treasury. At the same time, I understand why it's there. If you think about what's going on in Japan and the further lockdown, what's going on in China, and so I would tell you, U.S. rates look relatively inexpensive compared to Japan or other parts of the world. But I would not want to own it at these levels, especially with my view that inflation is more permanent meaning the next few years. And I'm not, I'm not talking about the inflation that like Brazil has seen. I'm talking about, could we see in the United States a 3% inflation rate, a 3.5% inflation rate over a number of year period? Yes. Is that a problem? I don't think so. But we're going to have to reassess our valuations and, what type of discounting rate are we going to be using, for returns of equities. But I would say in conclusion, markets are fairly priced. They're going to go higher. But I think we're going to have to pay a lot of attention to inflation. If it's not transitory, we're going to have to see, how does the central bank, how does the Federal Reserve navigate? Do they raise short rates and continue to QE in the intermediate term? I think that's what the market's saying, that they're going to do some tapering, but not only are they going to taper, they're going to raise short rates, but continue to invest in the intermediate term, because that's what keeps the economy going. And so they're going to, so I think the yield curve is saying that we're going to see very unusual activities by the central bank, but with the mindset that they're going to try to keep the economy going, continue to go. So that's another reason with that view why I would tell everybody, stay in equities.